All right, then. Hi, everyone. We'll give just a couple seconds for those that are still logging in. And we'll... Good morning, everyone. My name is Jesus Gutierrez. I am the program manager for the Building Business Back team. The Building Business Back, pardon me. This is our team. We have our Director of Operations, Paul G. Farmer. We have our Program Analyst, Jose Luis Barajas, and myself, the Program Manager, Jesus Gutierrez. Now, let's kind of break it down as far as what today is going to look like. We'll be diving a little bit into what the Building Business Back team does. We'll jump then into the presentation by our CPA, Pruneda, and we'll hold questions and answers at the very end. Now, what is Building Business Back? Building Business Back helps all businesses in Monterey County with a special emphasis on those belonging to historically underserved communities such as women, minorities, and the LGBTQ+ community. Our program serves primarily as an informational hub where business owners and entrepreneurs can find and access resources they need to be successful. Our team regularly updates our websites with new grants, loans, utility, government, contracting, and many other programs of interest to businesses. We also host a number of hybrid workshops throughout the county that cover a wide range of topics, including startup assistance, navigating the permit center, and getting certified as a diverse supplier. Most importantly, you can always count on assistance from one of us, the BBB team members. Our main office is in Salinas, but we recently added satellite office hours in several cities, including Soledad, King City, Pájaro, and Monterey. So, our speaker comes with over 20 years of experience as a CPA in Monterey County and has been helping many businesses throughout the county apply for the Employee Retention Tax Credit. So without further ado, I'll kick it off to Laura Pruneda, our CPA.
Hello. Hi there. Pleasure to be here. Yes, as Jesus said, I have been a CPA for 20 years, so that means I get the distinct pleasure of always trying to figure out tax pronouncements and getting into the tax code. So today's tax code is going to be, we're going to talk about employee retention credit and how we can potentially get some money back to some small businesses like yourselves. So first of all, let's go, Jesus, could you get me on slide 1, please? So what is our ERTC? So in essence, it's a refundable payroll tax credit. Of laws enacted by Congress small businesses in order to maintain folks on payroll. So they didn't want businesses to be letting go of their employees. So this was in the interest of keeping folks on payroll. It got a little bit confusing over the course of the years. Congress tried to act very fast. So they came out with the initial CARES Act, and that was in March of 2020. So that was, a very large and complicated piece of legislation that went out the door very quickly. And then there were 3 other iterations of that legislation. So If you happen to have talked to a CPA before and they told you didn't qualify at that point, well, it's worth maybe revisiting, because there were a lot of changes, and businesses that didn't qualify early on ended up qualifying later. So this refundable payroll tax credit is actually money that you will get back. It's, most of and there's two different ways to do it. You can either elect to get money back, or you can use the credit towards future payroll taxes. But most companies that I've dealt with, they like to get that refund back. Next slide. So, okay, well, how much is this credit worth to you as a business owner? Well, it all depends on your number of employees, right? So this is, as long as you have payroll and you have employees and you qualify, then the credit could be up to $26,000. But that breaks down into two different years. So in 2020, legislation said, okay, well, to the extent that you have employees that have wages up to $10,000, we're going to give you 50% of that back. So, so $5,000 per employee per year. So that is distinguished from 2021. That's a different situation. 2021 was a per quarter situation. So in 2021, they said, okay, up to $10,000 of your employee obligations, you can get 70% back. So there are some limitations as far as if your employees getting over 200,000 and whatnot, then there's some issues there. But as long as you have employees under a certain threshold, like let's say $50,000 annually. Well, we look at things by quarter, and as long as they're not north of $10,000, then we would be able to take that 50% or that 70%, depending on which year. And we'll get into qualified wages, because there's sort of some kind of rules of the road where some wages are not qualified, but we'll get that into the next slide. Let's see. So the potential, if you see the diagram here, the potential ERTC per employee could be up to $26,000, and that's $5,000 for all of 2020. And in 2021, they moved it over to $7,000 maximum per quarter for the 3 quarters. There is a 4th quarter that is eligible, but the business would have had to have been a recovery startup business in order to qualify in Q4 of 2021. Okay, next slide, please. So as far as qualifying, there are 3 basic tests that the IRS has established. The first one is declining in gross wages. The second one is whether or not the business had to be closed, whether fully or partially. And then, as I just mentioned, that recovery startup business. And we'll get a little bit more into the details of that in the next couple slides. But the period that is under ERTC would be March 13 of 2020 through the end of September of 2021, unless, of course, it was a recovery startup business, in which case Q4 2021 would apply. Now, wages, as I mentioned, those are Social Security wages plus health benefits. So if an employer had a sponsored health plan, then whatever the employer paid on behalf of the employee, then that could be used as qualified expense wages. And then, of course, then they get capped. So in any given quarter, for example, if you have an employee that in one quarter made $15,000, when you add both their wages and their health expenses, then that 15,000 gets capped at 10,000, and then you take either the 50% or the 70% of that. So that's how that math works. Now, there were also other government programs, as you guys, as business owners, probably aware, there was a paycheck protection plan, and to the extent that those were received and forgiven, then we have to do a deeper analysis of that. It's not to say you couldn't get both PPP and RTC, but we have to look at specifically at the amounts and the periods. So in essence, the IRS and the Small Business Association doesn't want you to double dip on that credit. So that would take a deeper dive in terms of an analysis for those business owners that receive the Paycheck Protection Plan funding from the SBA. And then, of course, other exclusions applied. So there's wages for sick and family leave. Those wouldn't be able to apply. And if there were wages related to, say, severance packages, that also does not qualify as eligible wages. And then we have the size of the business with respect to employees. So if you had employees that were over 100 employees in 2020, then the only qualified wages are going to be for folks that got paid even though they weren't working, kind of stuff. So there's some nuances there depending on the size. So most of the businesses I think that we're talking to are not going to have necessarily 500 employees. So in 2020, there may be some exclusions for whether or not employees got paid when they weren't working. So just little details there that we don't necessarily need to worry about at this point. If we have an employer that's over 100, has over 100 employees, then we can have a deeper discussion on that. So next slide, please. Okay, so the qualification tests are, like I said, 3 ways. So 3 qualifying pathways. The first one is the most objective test. It is kind of a simple analysis. What we do, it's declining gross receipts. And that declining gross receipts would have to have hit a threshold of 50% in 2020 and 20% in 2021 as compared to 2019. So 2019, whatever your P&Ls on a quarterly basis say in 2019, that is the anchor. So we look at 2019 and then we take that same quarter for 2020, and to the extent that there was a 50% reduction, then that employer, that business would qualify. And for 2021, we were already sort of come back on recovery. So they reduced, the IRS reduced that to a 20% reduction in gross income to qualify. Now the full or partial closure pathway, that is a subjective test. It is a little bit more complex, requires a deeper dive. Essentially, you have to know your U.S. governmental order that limited your commerce, travel, or group meetings due to COVID. So you have to actually reference and have documented when the closure began and when the closure ended. And that qualification depends on a quarterly basis. That one happens on the that it was reopened. So you have to be very specific about those days as far as a closure. And that's a little bit more complex. And there's some additional rules that we'll get into regarding aggregation a little bit later. The recovery startup, that one is quite simple. There's 2 basic requirements. It is for the brave and the bold that decided to go ahead and open up the business during a pandemic. So if a business started after February 15th of 2020 and there were annual revenues of less than $1 million, then they would qualify. And for those businesses, they would qualify in Q3 and Q4 of 2021. Again, there's some rules such as aggregation rules and whether or not a company had paycheck PPP funding, and there's family attribution rules. There's a lot of sort of if-thens in the legislation. So, this is sort of a basic overview. And if a company, for example, I had a company last week that it looked like they were part of the recovery startup business because they started in March of 2020. And the company alone was under $1 million in annualized revenue. But then there was another element where, okay, this business owner not only owns business A, but they own business B. So all of a sudden we are subject to aggregation rules. That means we have to do our analysis on business A and business B. And so to the extent that both of those businesses are under $1 million, then that business would qualify. Otherwise, they would not qualify. So there are sort of, trumped situations along the way that make it or break it as far as a qualification. Okay, next slide, please. So the declining gross receipts, like I mentioned, it is very objective. You provide your P&L statements on a quarterly basis, and we would drop them into a table such as this. So if you, and then if you kind of pull your attention to the far right table where it says 2019 versus 2020, and the one next to it is 2019 versus 2021. So notice up above it says 50% is the trigger to qualify and 20% is the trigger to qualify in 2021. So where you have highlighted in green, that's a qualifying quarter. So if you have, Q2, it looks like Q2 in this case, there was a decline in gross receipts of 51% quarter over quarter from 2019 to 2020. Well, that's a qualifying quarter. The next quarter, Q3, again, looking at 2020 versus 2019, there was a decline in gross receipts of 52%. Now, that fourth quarter, you see that where it's 39%, well, that's not more than 50%, but the way the rules work is that your qualification ends on the first quarter of or first day of the quarter preceding when you came back up above the 50. So that means that fourth quarter also qualifies. Now, on the next, in the 2020 category, you have the negative 26%, negative 22%. Those two qualify on standalone, but then that third one, where it's 19, that actually still qualifies because legislation allowed for an alternate alternate quarter election. So basically what you can do is you can take the Q2 numbers and you can substitute them for the Q3 numbers. So in our footnote C and D, that means those two qualify for. So for in a situation like this, you would have 6 qualifying quarters. So once you qualify, then what we would do is we would actually look at the employees, sort of switch gears, look at, the payroll details, look at DE9 details, understand whether or not there was paycheck protection plan involved in the equation, and then proceed with that analysis. So next slide, please. So the partial closure example, partial closure is subjective in the sense that there's, it's not so black and white, right? In the declining gross receipts, that's rather black and white. Either there was a decline in gross receipts by 50% or not. Either there was a decline in gross receipts by 20% or not. Now with a partial closure, you can have an entire company still be an essential company. Like say, let's take a hospital. A hospital was deemed essential, but there are some hospitals, there are some hospital activities that were non-essential. For example, elective surgeries. So to the extent that those elective surgeries were no longer allowed, then well, a hospital was an essential. So that, maybe this is not the best example, but let's say a hospital was a non-essential, but that one piece that one piece was greater than 10% of all of gross receipts, that piece being the elective surgeries, then that would qualify them. So going in this particular, going right off the slide, the fact pattern here, we're going to talk about an owner that has two businesses. And let's say this owner, she owns each of those two businesses at 100%. So as an example, business A is a grocery store and business B is a jewelry store. So according to government mandates, we're saying business A is an essential business. It was a grocery store, so that was deemed essential and allowed to remain open. Business B, however, was not an essential business, and so they had to shut down. So if we look back, remember that 2019 is your anchor year. So if we look back in 2019, and business B being the non-essential business that was asked to close down, or mandated to close down, I should say, if the gross revenue was 13% of the aggregated revenue, so that means we're looking at business A plus business Z gross revenue in total. And to the extent that the gross revenue for business B was greater than 13%, then that means that they would qualify. And how did, what is the period that they qualify? Well, it's the period of the closure. So it's not on a quarterly basis. So we literally would have to tease out and do the research and figure out like, okay, well, on April 10th, 2020, this business was asked to close down. And then California had different sort of triggers as to when they can open up, and there were 4 different levels. So we would have to figure out, okay, when were they allowed to open up, and take that specific date, and then for the payroll within that date, then that would qualify for ERTC. Again, if there was a payroll protection program monies involved, then that's a little bit of a complexity in analysis, and we would not be able to use the same wages for both. Next slide, please. Okay, so when does this expire? Well, the second quarter of 2020 has already expired. So if you look at the amended due date, sort of shadowed in gray, that 7/31 date has come and gone. But that's okay, because 2020, remember that credit was maximum 5,000, and it was based on an annual basis. So there's still time for Q3 and Q4 to be able to get some, credits going for those 2 quarters, and and depending on the nature of your payroll, some businesses could get that whole 5,000 per employee. 2021, we have until 2024. So basically what happens is from the original due date, you have 3 years to submit an amended return. So there's still time. We have the most of the credit is in 2020 in the 2021 year, so we have until 2024. Not to say that anybody that thinks that they qualify, they should probably try to get to us as soon as possible. I would be next slide, please. So I would be remiss if I didn't mention this. There's some current IRS issues. The government moved really fast in trying to get monies out to people, but in doing so, and as you can, as I mentioned before, legislation changed. There was a lot of confusion. There was not enough guidance coming out of the IRS in terms of how to do things. So they have basically cracked down and are now allocating quite a bit of their funds for audits. So, and to that extent, they did, the IRS, that is, issue some press releases, advising taxpayers to be worried about third-party servicers, because some third-party servicers aren't, they're not necessarily CPAs or EAs, and they don't even sign the amended tax return. So for those types of third-party services, you just have to be really careful. And there's this thing called the dirty dozen that the IRS looks at, where the IRS identifies different areas of concern where they're going to allocate their time and their resources in order to sort of increase their enforcement activity. And this is number one for 2023. So, you got to make sure that you use a reputable organization, a CPA like myself, and to be able to do this. And to that, and just a quick aside, one of the things that we do that even other CPAs don't necessarily do is give you a fully auditable package. So what you get in working with us is not only a CPA with 20 years, but also you get an audit ready package, so that at some later point, if the business gets audited for ERTC, then you have a document that's anywhere from 50 to 100 pages where you have all of the source documents clearly outlined and easy to read for an auditor to take on. So that takes out a lot of the headache and the stress for anybody, any business going to do an audit. Next slide, please. Okay, so for those of you who are interested, what are the documents required for the analysis? That I think I mentioned a couple of times, the profit and loss statements. They're also known as income statements by quarter for 2019 through 2021. We would have to have all the 941s that have been filed. And depending on what is the pathway for qualification, California DE9s would be required for the decline in gross revenue. If there was, if the qualifying pathway was the partial or full closure, then we need to look at detailed payroll reports. If Paycheck Protection Program funds were received, then we need to look at the actual application. So the application for forgiveness, that is. So when the business asked for a forgiveness, they would have had to apply for that forgiveness and give a breakdown of how much of that money was used for payroll. And whatever is on that application is sort of locked and loaded. For example, if a company got $100,000 in PPP and they said it was all for PPP, then that means that's $100,000 of payroll that we cannot use for ERTC purposes. What was required by the SBA was 60% of the PPP to be used for payroll. So for those people who got the $100,000 and who actually itemized on their forgiveness application and said, okay, well, we use 60,000 for payroll and then we use other for rent, utilities and whatnot, then 60,000 cannot be used for ERTC purposes. So that's why that letter or that application and the letter of forgiveness is important to this process. And then finally, if a business owner has multiple businesses, well, we need all of the above information for that other business as well, because to the extent that one business owner has more than 50% interest in multiple businesses, then they're considered a single employer. So the analysis has to be done as a single employer. Even if the 941s are filed separately, we still have to look at them as an aggregate owner. And it doesn't matter whether, the businesses are related in any type. Some business owners have completely unrelated businesses, like a retail store selling clothing, and then they'll have a restaurant. And so they're completely different, but we have to unify them in our analysis and consider the gross receipts or gross income on an aggregated basis. So this can be a little bit complex and hairy in some places, but I've tried to simplify it and just give you a general overview. And so at this point, I'd like to open up to any Q&A.
Alrighty then. Thank you so much, Laura. That was a lot of information for for the ERC and a lot of things that businesses need to take into consideration. We do have quite a bit of questions. Obviously, it's a big topic and a lot of very complex within its own. Let's see. I did see that some of the questions you did answer during the presentation.
Okay,
But maybe if you could either restate them, clarify, or maybe even go a
absolutely,
little bit
yeah.
more in depth. So the very first question was, are there types of businesses that do not qualify for the ERC?
I'm sorry, are there types of what?
There's types of businesses, I'm assuming this, certain industries that don't qualify.
No, I mean, at this point, like government doesn't qualify, non-for-profits do qualify, and any trade or business does qualify as long as they meet the test. So so as long as there's a declining gross revenue for any trade or business, or there's a partial closure, then they would qualify. And that includes your, for-profit businesses as well as your non-for-profits. It's the governments that don't qualify.
Gotcha. And then I also see that someone over in Soledad is raising their hand. Go ahead, Soledad.
I'm sorry,
Hello?
what's the question?
I think they're having some technical difficulties, but we can circle around to that one. So another one that I did receive was, I've been told that the wage amount of an employee an employee receives counts towards how much I'm able to receive in ERC credits. Is that the case?
The wage received, as in if you're a high wage earner, yes, there's a limit, and I have to look up that limit. But yes, high income wage earners would still be subject to that 10% cap.
Gotcha.
And there is an interplay, like for example, PPP, if there's, we can allocate up to 46,237 or something like that to business owners, but typically business owners are going to be excluded from eligible wages.
Okay. Alrighty then. And then it says, the next one is, when is the latest I can wait until I can claim the ERC? For example, if I have not completed my tax returns, when can I submit it? And I think you had a diagram up, correct?
Yeah, I have the diagrams. So it's basically the expiration date is the 3 years from the date that it was due, or 2 years from the time that it was paid. So those are the, so if you take the original due date, let's just assume that you paid on the original due date of 10/31/20, and then you have until 10/31/2023 to claim for third quarter 2020. So yeah, so you just take your due date per quarter and then add 3 years, or from the date that you paid, add 2 years.
Gotcha. And then there's a follow-up question to that. So since they are submitting their taxes late, does it matter when they're submitting it and compared to when they're able to submit the ERC application? Does that make sense?
Yes, and actually, thank you for that question, because one of the things is that whatever credit is received up affecting your deductions for taxes. So if you haven't filed you could still apply for ERTC without having filed your taxes. That's not a problem. But you would have to reduce your deductions for your tax returns. And for those folks, I mean, we're in 2023, so most businesses have filed their taxes for 2020. So in those situations, they would have to do an amended return. Like let's say you got ERTC funds of $120,000. Well, that means you need to go back to your 2020 tax returns, and you need to refile those 2020 tax returns to account for the fact that you didn't, you got that credit, and that credit is not included as income. It is just a reduction in your deductions. So either way, what it means is that for those that have already filed their 2020 tax returns or even 2021, they would have to do an amended tax return to account for whatever credits they received. And then just to reiterate, yes, you can file for ERTC even though you have not filed your income tax return. However, if you owe payroll taxes, then the IRS is going to net whatever you have, whatever credit you are entitled to. They're going to basically net that. So hopefully everybody has paid all of their 940s and 941s for those years.
Perfect. Thank you for that. Okay, so I do have another question online. They're asking, do agriculture businesses qualify since we are usually operating on the seasonal period, not year round? And how would that affect the ERC?
Yeah, I mean, that's it's okay that the seasonality part isn't necessarily an issue because you could still have some decline year over year. So depending on the different pathways, I don't think agriculture had to close down. I think they were considered essential businesses. But again, remember that our analysis is done on an aggregated basis. So if one company had, one agriculture company had a common ownership in another company that didn't do as well, then that would potentially qualify both companies for ERTC. And seasonality, yeah, we would just look at 2019 versus 2020 for that season to determine whether or not there were gross receipts. So yeah, I don't think that agriculture would qualify as far as for a full or partial closure unless there were other companies involved that were more than 10% and therefore use a nominal test to qualify that ag company.
Got it. Okay. And then I believe Jose Luis is physically in the Soledad City Hall, and he has a question. Jose Luis, if you want to go ahead and unmute yourself.
All right, thank you, Jesus. So I have a business owner here, Ariana, and she has two questions. The first one is her business in particular didn't have a robust financial tracking system, such as QuickBooks, for certain years that for ERC. So is the profit and loss statement absolutely necessary to determine eligibility?
Yeah, yes. So remember that the IRS is cracking down quite a bit on ERTC, and they're unleashing audit teams to review and audit these calculations and these returns. So yes, you want to have some support on a quarterly basis. So as I mentioned, when we get involved in doing these returns, we require the quarterly statements so that for your own protection as well, because we include those in an audit ready package for should should an unfortunate event happen where you're getting audited. But yeah, that's really the basis of the qualification, is to understand what your numbers are, and then compare those numbers year over year on a quarterly basis.
Thank you. And the follow-up question to that is her business in particular also received PPP, but they weren't aware that the PPP program was a forgivable loan. So they haven't applied for forgiveness. Would it be more advisable to apply for PPP forgiveness, or how might that affect their ERC return or eligibility?
Yeah, you get more bang out of your buck on a PPP loan forgiveness because that's dollar for dollar, right? You're looking at getting either 50% or 70% off of a max of 10,000. A PPP, even owners of companies can use up to 46,000 on PPP. So you get a lot more bang for your buck on a credit with a PPP. However, that being said, I think that the date for the loan forgiveness has passed, and I would have to double check on that. but I encourage this business owner to go to the bank where they got their loan and talk to them, because I think that, you know, these banks were helping set up the PPP loans. And also, you know, I could just as easily look it up, so I can also help, you know, after this presentation, I can just look it up for you.
Thank you.
Perfect, perfect. And then kind of moving on with the topic of the PPP loan, what is the impact that a PPP loan takes into your ERC return? For example, if you're supposed to receive 50,000 in ERC returns, but you took out and have already gotten forgiven a $20,000 PPP loan, is it dollar for dollar that it impacts the ERC tax credit, or is it kind of as a fraction or whatnot?
Yeah, so there is a kind of an intricate interrelationship between PPP and ERTC. So what we would do is we would have to, you know, depending on how the business qualified, whether it was by the gross receipts or the partial closure, we would look at how much of that of the payroll we can allocate first to PPP. So in order to get the most bang for the buck, you allocate as much as you can to PPP, and to the extent that there's still wages that are eligible and unused by the PPP absorption, then you can use those for ERTC. And it has to be done. And so, I mean, the complexities are you have to in the case of like partial closures, you have to get like, okay, how much did this person make on this day of the closure? So you have to do it by, you know, a daily basis. So yeah, once you get in the PPP versus ERTC relationship, then we're doing a lot more sort of math and you know, allocating first to PPP, and to the extent that there's wages left over would go ERTC.
I got it. So more of anything, it's more of on a per quarterly basis, where it possibly kind of changes the amount of what the effect the PPP loan has towards the ERC, correct?
Well, yes, but when we're talking about quarterly, like an analysis based on a quarterly basis, that's because we're talking about declining gross receipts. When we're talking about a full or partial closure, we're not talking about quarterly. While we report on a quarterly basis in the 941, the mechanism to get your money back or to get a credit is a 941X. So that's how we report it. But when we're doing the calculations, we're not looking at a quarterly. We're looking at, like, say, for example, you know, March 13th through July 20th. Well, if that's the PPP coverage period, then it spans 2 periods. And we have to get like the payroll very specifically for those for that time period, right? If you have a monthly payroll, well, all of a sudden it's not a clean, it doesn't align very clean. So now we have to dig into like, okay, well, how much did this person make starting on this day from this day? So we have to be much more clean and precise when we're dealing with a partial closure situation.
Gotcha. Alrighty then. And then moving on to the next question, is the ERC taxable? They've heard back and forth that it is and it isn't, and they just want a straight answer whether if they do receive a refund for the ERC, if they will be having to report it later down the road.
Okay, so it's not taxable. However, because it's not being included in income, right? But however, it does reduce your payroll, right? So remember how I said you have to go back to the year, like if you earned ERTC funds, or if you got an ERTC credit for 2020 and you already file a federal income tax return, now you have to go back to your return. And it's not that you're being a tax on the credit itself. What you're being taxed on is the fact that now your payroll for 2020 is lower than it was, right? Because you know, you got that credit. Let's say you had you claimed in 2019, you claimed $100,000 in payroll. It's a low number. I'm just trying to make things simple here. But if you claimed 100,000, but then you got a PP or a ERTC of 25,000, well, all of a sudden now you have to go back and you have to file an amended federal income tax return that says, oh, I paid 75,000 in payroll, not 100, right? So that $25,000 variance, yeah, that's going to impact how much you owe in taxes. But it's not that you're paying on the tax, you're just paying on the variance of that payroll expense for that year, because all of a sudden you have less deductions. So the credit itself is not taxable, but the reduction, to the extent that that business paid less in payroll, then there's a tax consequence.
Gotcha. And that could lead into having them have to pay later down the road, correct?
I'm sorry?
That would lead to them having to pay either on the next tax return or once they filed amendment to the previous wages.
Actually, yeah. I mean, if there's a delta of 25,000 on your tax return, then yes, that will potentially have an impact on tax obligation for that year on the federal income tax return.
Gotcha. Alrighty then. So the next question, and I think this is a pretty easy one, and I believe we have the slides for it too, were what documents do you need in order to get the process started? I did put them back on the screen so you guys can take a look, write them down, or take a picture. And then if you want them in an email, I can also forward that over to you guys. And then the last question that I have online is, does it matter if I submit my taxes yearly instead of quarterly, or vice versa?
Which, I mean, 941s are due on a quarterly basis, so I'm not sure.
I'm assuming they're talking about the 943s, if I'm not mistaken. I believe that's the yearly.
Yeah, we can take a look at that. Now, so one of the things about this document required for analysis, instead of sending everything over to Jesus and Jose Luis, I would encourage you to, can you go back, Jesus, to the declining gross receipts slide?
Partial. There you go.
Okay. So I encourage you to do this for yourself first. And then once you see this happen, because it's an extensive document request list, and it's a lot of work for you to, as a business owner, take your time out to give us everything that we need, only to find out, oh yeah, we didn't even get to first base on this. So if the businesses could go ahead and try to establish getting to first base on their own by and I guess Jose Luis and Jesus, maybe you can send them that template, and they can drop in these quarterly numbers, and then to the extent that it works out as 50% north of 50% reduction for the 2020. And then the 20% reduction for 2021, and then we can proceed. So we don't have to do a lot of work in the event that it's a no-go. And of course, for aggregated businesses, it's a little bit more complex, but we should probably still try to do, at the very least, a declining gross receipts analysis before we get to partial closure. And then as far as partial closures, for those that want to hang their hat on the partial closure pathway, we need to understand, how it is that was there a government, did you have some sort of a government agency telling you needed to close down? And one of my clients literally had, Monterey County health department out there letting her know that, hey, you guys have to close down this part of your business. And so to the extent we have that, then that is like sort of the bookend of where we start on the closure analysis. And then we have to figure out when they were open. So hopefully businesses will know based on their own research, and so sort of somewhat of like trade associations. I know like the restaurant association was really strong, and was very vocal in keeping their membership and their industry up to speed on when they could reopen. So hopefully they have the closure date and the reopen date in order for us to be able to do the analysis more expeditiously.
Right. Got it. Perfect. Well, I don't see any other questions online. Jose Luis, by chance, would you have anyone else in person that has any last questions? No, it doesn't look like it. Well, if that's it, then I want to thank you, Lara Pruneda, for sharing the important information regarding the ERC. A lot of information, a lot of different things that need to go into it, and I'm glad that we were able to at least inform the businesses exactly where it is to start, for them to be able to take advantage of this tax credit. And if anyone online would like to get in contact with either Laura or my team, please feel free to reach out. We're more than happy to help out or answer any further questions after this workshop. I also want to thank the City of Soledad for hosting our workshop today. Our services and workshops are free because the County of Monterey has dedicated funding to helping businesses recover from the COVID pandemic and to thrive throughout the county. If you're interested in learning more, feel free to visit our website, montereycountybusiness.com, where you'll find this workshop's recording as well as previous workshops we've held. The last comment before we let you go is our next workshop will be digital marketing for small businesses, held August 24th, and you can register for that on our website. That's the end of our workshop. Thank you all for joining, and I hope you have a great rest of your day.